Hello, everyone, and welcome. Happy New Year. Thank you for joining us this morning. We have got a wonderful presentation in store. The purpose of the meeting today is to talk about the 2026 market outlook and what to expect for the coming year. We are going to talk about key themes in the market and trends to be on the lookout for. Also, a little bit about what to expect with interest rates, and why diversification continues to be important in this market. Um, and we have a wonderful presentation for you today. If you can see on my screen, the gentleman here, his name is Jeffrey Bookbinder, and he is one of the chief equity strategists at LPL Financial. So he has kindly offered his expertise for us today. He has been with LPL for over 20 years. He is originally from Kansas City, now living in Boston, with four women in his household. He's got two teenage girls. He's married, two teenage girls, and a cute little dog, Bella. So we are grateful to have you here with us today, Jeff. He's going to talk for about 20, maybe 25 minutes about these topics that I was just talking about with you. And then we're going to leave time for Q&A. So as we're talking, if you have any questions, just go ahead and jot them down, because we're gonna take questions after his presentation. And we're just gonna do that by raising hands. I think we've got a small enough group today that we'll be able to do that. So again, Happy New Year, everyone, and thank you for joining us on this Tuesday, which kind of feels like a Monday, so we appreciate it. And before we get started, there is one thing I was going to say. For those of you who know me, I'm big on quotes and inspirational sayings. So I was looking at a few before today. One of the ones I came across was, when you're stuck on the next thing or the last thing, you miss the now thing. So I always think that's good advice, just to stay in the present. And again, thank you for being with us now and giving us the next 25 or 30 minutes to share together. So with that, Jeff, I'm going to let you take it away and share your screen, and then we'll come back in about 25 minutes for some questions and to wrap everything up.
Wonderful. Thank you so much, Megan, for that nice introduction. Hopefully those slides are showing up the way I have intended them to show up.
I think, Jeff, I think you still might be in the preview.
I'm still in the
Um,
preview mode. All right, well then
but
let's go
you did
ahead,
change that. Yeah, I think you've got that
go ahead
before.
and share the slideshow. There we go. All right.
Beautiful.
Wonderful. There we go. All right. Well, thanks again. Megan, thanks to all of you for joining today. Really appreciate your valuable time. So LPL Research just put out this Outlook publication. Well, I guess it's been about a month now. In December, titled Policy Engine. And the reason that we did that is because we expect policy to be a big driver of markets in 2026. Now, the nature of the policies will change a little bit. We thought we'd be a little bit less focused on tariffs, although that is the focus today. Over the course of the year, we'll be less focused on tariffs, we think. And then we'll be a little more focused, of course, on the midterm elections. So beyond that, I think it's going to really look a lot like 2025 in terms of what we're focused on. So I'll get more into the key drivers of markets in 2026 here in a moment. We'll start high level with the economy. The more things change, the more they stay the same. So really, the economy in 2025 was about artificial intelligence investment, just like it was in 2020 or will be in 2026. We also had a little bit of a slowdown in economic growth last year, and we'll probably have a little bit of a slowdown in economic growth this year, although we think as stimulus kicks in, I'm referring to the One Big Beautiful Bill Act, that's a lot of money being spent. That, including tax refunds, which are going to start coming very soon. That may cause a little bit of a pickup middle of the year, So we'll end up with, moderate growth, but certainly enough, we think, to ward off recession. So we don't think there's a recession coming in 2026. Here's our GDP forecast. You see there's a little bit of a dip sort of in this Q4, Q1 time frame. These are quarter over quarter annualized numbers. So we think we'll get back up into this 2% kind of run rate here over the next several months. I actually think there's a little bit upside to these numbers, but this is our forecast, and it's going to be pretty easy, we think, to get there because the AI investment is expected to be potentially almost 1% of GDP by itself. We're talking about something in the neighborhood of $500 billion of investment. And then you have the stimulus bill, One Big Beautiful Bill Act, which is expected to be potentially even, gosh, could be similar, maybe even a little bit more. So we're talking about a 2% growth rate just from those two drivers. And everything else can just be gravy. There will be offsets, but it looks very likely that we're going to get a 2% growth here, which is just fine given the structure of the US economy. So inflation, of course, is a big topic these days. It's a big topic for the White House as they try to fight the affordability challenge. We actually think there's going to be a little bit of an uptick in inflation in the very, very short term, but then we will quickly reverse those increases as tariffs are fully digested. And then over the course of, let's call it the last 9, 10 months of the year, we think we'll be in a decelerating environment for prices. So one of the reasons we say that is because this ISM Services survey, this is a survey of businesses, the blue line, where they're asked, are you going to raise prices or cut prices? And you can see that blue line's been pretty correlated with the orange line, which is the CPI, the inflation number that we're all familiar with that gets reported every month. Right. So this tells you that the CPI could play a little catch up to this ISM survey. But after that, again, the tariffs are fully digested. We think we're going to roll back over. And by the way, the Trump administration is putting some policies into place, or at least they're trying to put some policies into place to curb housing inflation. And that should help the overall inflation number too, again, over the course of 2026. So be patient. A lot of people ask me, are mortgage rates going to go down? Should we wait to buy a house? Mortgage rates are pretty close to 6%, which isn't bad. At least historically, it's not bad. But we actually think it could come down a little bit more because the 10-year yield is probably going to come down a little bit more. So this chart just shows you that the 10-year yield is correlated to mortgage rates, even though most mortgages are a 30-year obligation, right? So if the 10-year yield comes down, as inflation comes down, as I mentioned, and as the economy maybe slows just a touch, right? And the Fed cuts rates. The Fed is targeting a very short-term rate, of course. So if you have Fed rate cuts, a little bit of a slowdown in economic growth, a little bit of a slowdown in the labor market, by the way, which you've already seen. That is, and less inflation. That is a formula, we think, for a lower 10-year yield. So the 10-year yield, I think, is somewhere around 4.25, 4.3 right now. We think that can go back down to maybe 4% by the end of the year, but it's going to be very bumpy. There's a tug of war going on between the deficit, which puts upward pressure on rates, and inflation, which could put upward pressure on rates in the short term, and then the slowing growth and the Fed rate cuts, which are pushing in the opposite direction. So all in all, we have a pretty healthy, I think, forecast for economic growth. We are potentially going to get a little bit of a productivity boost from the AI investment that can also help temper the inflation pressures, by the way. So, 2%, that's faster than our population's growing, especially since immigration has slowed lately. So a 2% growth rate's pretty good. Again, I think there's a little bit of upside from the combination of the AI investment and the One Big Beautiful Bill Act. That's going to be a lot faster than Europe. And certainly, if we put more tariffs on Europe, that's not going to help them catch up. Europe almost always grows more slowly than we do. But in this case, we think that gap potentially could even widen a little bit more. We'll see. So look for maybe double the growth in the US as opposed to Europe. Same thing in Japan. Japan is in the news today because their rates are moving sharply higher and the debt markets are globally integrated. So when the Japanese government bond yields shoot higher because of what's going on there, that does tend to spill over into the US rates market. So that's why we're seeing a little bit of a uptick in rates, 10-year treasury yield I'm referring to in the US. And that is putting a little bit of pressure on stocks today, in addition to President Trump's threat of using tariffs to secure whatever his objectives are in Greenland. Still growth, not bad growth in Europe and Japan, but not as much as the US. But those equity markets are cheaper. So we still want to be globally diversified. Actually, they did a lot better than the US markets last year, including emerging markets. So being globally diversified, we think is important. So I'm sure you all are. Um, I guess the last thing I'll say here is emerging markets are growing quickly. The forecast here, 4% compared to the rest of the world, but that is actually a meaningful slowdown. And China still has some troubles in their banking system and with their property market. So don't look at this and say, wow, EM growth is doing so well. Maybe we should have a lot more in emerging markets. That's not our view at all. We're really neutral across the board. So staying in line with benchmarks across Europe, Japan, and emerging markets. Although, by the way, the dollar will be important in determining whether those markets do well again. That's really why they did so well in 2025, is the weak dollar props up international equity returns. That was pretty much the whole story. So let's turn to the stock market. That's just an overall economic outlook for the team. It's a pretty optimistic outlook. I think it's fair to say, and we're pretty optimistic on the stock market too. These same policy tailwinds that I just talked about, the One Big Beautiful Bill Act and AI investment, we think that creates a positive backdrop for stocks too, especially if inflation comes down and rates behave. This is a chart that shows how bull markets have done by year. And so we started a bull market in October of 2022. We're now in year 4. Historically, you see here this light blue bar shows you that the last 6 bull markets have been up in year 4. So no guarantees. This is a small sample size. But we think there's a good chance that even though this bull market is now maturing and is more than 3 years old, it's likely to get through year 4. Typically, what ends bull markets, either the Fed hiking rates aggressively or a recession or a financial crisis or a pandemic. And we don't think we're going to thankfully, don't think we're going to get any of those things. Lord help us. And that should pave the way for the bull market to get through year 4, just like it's done the last 6 times. I'm not going to draw a comparison to 1949 because I don't think anything going on right now is too relevant from 1949. All right, another reason why we think stocks go up this year, the Fed is cutting. Of course, we don't know if they're going to cut once, twice, 3 times. But what we do know is that the new Fed chair in May is going to have a bias toward cutting. And I mentioned the economic backdrop is conducive to lower rates. Again, as the economy slows a little bit, inflation comes down a little bit over time. Now, maybe these will be back-end loaded at the latter half of the year, but nonetheless, we think it's very likely that the change in leadership at the Fed and the economic backdrop gives us a rate cut or two. And this chart shows you that if you have no recession, the stock market's at or near all-time highs, and the Fed's cutting, stocks do well. That's really the takeaway from this slide. We just isolated rate cuts that happened when stocks were near highs and then broke out recessions. So this up 18% on average is no recession, stocks near highs, and a Fed cut 12 months later. right? If you have a recession, that's when you get these declines, down about 3% on average. So, we think we'll probably be more in the middle of this range because the stock market's done so well the past few years, but we think we'll be higher. So again, favorable backdrop with Fed cuts. The AI investment is just massive. We're talking $520 billion expected to be spent by just these five companies. This is staggering how much these companies are investing, how much they've told us they're going to invest. Of course, it's not fully guaranteed that they'll do all this, but we think it's very likely. These are these are called the hyperscalers: Amazon, Microsoft, Google, now called Alphabet, Meta, used to be Facebook, and Oracle, right? Not only is this a massive amount, but it's growing very quickly. That is just going to provide an avalanche of earnings because this investment is earnings for somebody, right? There's a certain chip company you've all heard of that starts with an N that's going to get some of that, right? The That's part of it, right? Is the earnings this is going to generate. The other piece of it is the productivity, we think. And maybe only like 20 or 30% of corporate America has said they're implementing AI and they're starting to see impact. So there's a long way to go. This is, I don't know, we debate third, fourth inning, maybe, of this process. This is a multi-year build out, just like the internet build out in the late 90s. But once it's done, we think these companies are going to, not just the ones listed, but really just about all companies are going to get a nice benefit in terms of productivity. So productivity allows you to grow your business by adding less labor. So we want people to have jobs, right? But we want higher profit margins and higher earnings too, to help support the stock market, to help support your equity investments, right? So this can really create a great backdrop, not just for stocks, but also the economy. Because if you can grow productivity, you stimulate less inflation. Okay, so this, again, it'll be fits and starts, but the opportunity here is really tremendous. I'm sure many of you have used AI already and been impressed. Here's the earnings I was talking about. The Magnificent Seven. So it's the seven biggest companies in the S&P. All the tech companies, not the previous list of five, but a similar group. You're going to talk about 25% earnings growth, we think, in 2026 for those companies. That's going to provide a tremendous amount of support for overall earnings growth and lift the stock market. Now, the rest of the market, the 493 is growing earnings nicely too, and that is improving. So we think that gap is going to narrow a little bit. The market is buying value stocks now in anticipation of that, it seems. But the most earnings is still coming from tech. So we certainly want tech to continue to be a sizable portion of our portfolios, just like it is for the market. That earnings support is tremendous. So in terms of risks, I guess one risk on the last slide is that spending doesn't happen because companies think, oh my gosh, this isn't as productive as we thought. We're going to pull back. Or companies say, you know what, this is too expensive. We need to be a little bit more careful with our investment dollars. Maybe the stock market demands that at some point. So that is a risk. We're not too worried about it, but it is a risk. The other risk is midterm election uncertainty because historically stocks are volatile around midterm elections. That's what this chart shows. The orange bars below the zero line are the average maximum sell-off in each of these presidential cycle years. So we just finished first year. The average we actually did more than the average, but the average is about 14%. Midterm year on average, 17%. So my guess is we won't get that, but certainly a correction at some point this year, as you get most years, we think is quite likely. And it might be more kind of summer, fall, because that's when you tend to get the political and policy uncertainty related to the elections. We don't have a big tax change on the docket, so maybe that helps limit the volatility. We don't have a big tariff, you know, it's not like a presidential election where you're either going to get the Harris agenda or the Trump agenda, which are very different. It's midterms. We're probably going to get gridlock, which is what we pretty much get in all midterm elections, especially when you go into the midterms with one party in full power. So that's probably going to be a little bit uneventful, we think, which means maybe we don't have to get that average drawdown of 15%. Maybe the biggest sell-off you get this year is sort of 7 to 10. That's a reasonable guess. So let's do bonds real fast, and then I'll wrap up here. The I talked about how the Fed targets a really short-term rate, right? It's Fed funds. It's kind of like the 3-month T-bill rate. So if you want to get a correlation between the Fed funds rate and a long-term rate, which is the 10-year Treasury yield, you want to look at expectations for where the Fed will go. So that's what this chart does. It looks at where the market expects the Fed to go in December 2026 and compares that to the 10-year Treasury yield. And so if the market expects the Fed to go higher with rates, then you go upper right here and you could have a 10-year at 475. The market right now expects cuts. The market thinks we're going to be down here, 4.25. So that's where we think we'll be. We could even go a little bit below 4, depending on what the new Fed officials do, because President Trump might be able to replace 3 people actually on the Fed board. But anyway, not to get too in the weeds, we think we'll be down here. Pricing in 2 or 3 more cuts this year, and then you end up, based on this correlation, with a 10-year yield around 4. All I'll say here that this is just telling you that credit markets are healthy and that companies can borrow pretty cheaply right now, and that means no recession. At least very, very unlikely no recession. This last column here, this just shows you the different bond sectors. Rates can go higher and we can still make money in bonds. That's what this chart shows you. In fact, you could even go up about 0.5% across all these categories in yields. So that would put us up at probably 4.5 and still have positive returns on bonds. So stick with your bond allocations, even though rates are ticking a little bit higher right now. We think they provide a nice amount of income and cushion in case the stock market drops, in case economic growth is worse than the market expects. This is a nice little cushion to have. So don't worry too much about rates. Bonds are going to generate nice returns. I mentioned the dollar is a key factor in whether international equities beat US equities. We're right near this kind of support line. So watch, if you guys pay attention to the US dollar index, we think it needs to hold around 97. I think it's around 100 right now. If that dollar index breaks down below this trend line, that could introduce more weakness, which could cause international equities to outperform again. So we're watching that really closely. I bet many of you are concerned about gold. So I'm going to go just show you one gold chart. So gold actually started its steep ascent, I guess we'll call it, related to events, I think it's fair to say. Russia invading Ukraine and the world sanctioning Russian assets was the first event. And then I think the Middle East turmoil would be event number 2, which clearly increased the Western involvement in the Middle East. We know what happened there, certainly with Israel and with the U.S. Strikes on Iran's nuclear capability. This told, many of you have heard about the world sort of becoming multipolar, right? Where you have sort of, China and Russia and Iran and North Korea on one side, and then the West on the other, right? Well, the sort of Russia-China pole, if you will, wants to make sure that they can keep their dollars, right? They don't want their dollars seized. They don't want to fall prey to sanctions. So what are they doing? they're buying gold. They are swapping their dollars for gold. This is putting some weakness on the US dollar over the past 12 to 18 months or so. The So this top chart just shows you gold's doing better than stocks. We actually think it's okay to have a little bit of gold in portfolios, by the way. I personally do have some in my own accounts. The ETF demand is coming from retail. That's us. That's the orange piece. And then central bank demand has been a steady factor here over the last few years. It wasn't as much in 2020, 2021. This kind of aqua colored um, piece of these bars, right? That's central banks buying. That's getting a little bit less dependent on US dollars. We're still the leader. We're not going to lose our reserve currency status. We're used in something like 85% of all global transactions, the dollar. But uh, certain central banks are diversifying and benefiting from the climb in gold. So wanted to just mention that before I wrap. And at this point, happy to take questions. Of course, I'll show you these disclosures and I'll give you a lot of time to read every word before I end, Megan. So bear with me while
Per-
we read very carefully all of these wonderful disclosures. And then I'm happy to take questions, and I hope you found some of that helpful
Yeah.
and
Thank you,
interesting.
Jeff.
Sure thing.
I'll let you continue cycling through that. Um, and thank you everybody for joining us today and being with us and the trust that you place in us, right? To help you manage your financial plans and manage your portfolios. And I do think that that is key as a reminder of how we work together and each of you, understanding what phase of life you're in, what's important to you, and the foundation of what we do is building your financial plan, and which really helps us determine what the appropriate asset allocation for you is, right? Not every client has the same allocation, has the same time horizon, has the same goals. And so looking at this to say, how much risk do you need to take to get you where you need to go, and making sure that we know where you're trying to go and also how that changes over time, right? A plan is always important, but it's important to come back to the plan as we always do. What's changed, what's different, what's changed in your life, what's changed in the markets, right? What did we anticipate and what have we gotten, right? And how do we pivot and how do we utilize the research like people like Jeff do in your portfolios to make sure you're positioned the right way based on what's important to you. So again, thank you for the trust that you place in us every day to help you manage your portfolio and sort of be in this together with you. So thank you again. Um, with that, anybody have any questions for Jeff? And I can't see, and either Julia or Brian or Jeff, I'm not sure if you can see if somebody um, raises their hand because I can't see the participants.
There aren't any hands raised yet.
Okay, perfect. Um, I that's always a good sign, Jeff, because that means you nailed it, you crushed it, you answered every possible question there is. And as everybody knows, if anybody has a question, you're welcome to come to us with questions. We can help answer those if that's not something that you want to ask in front of the group. We'll make sure we get your questions answered. Um, so I'll ask a question while we wait and see if we have any. Jeff, anything more you want to say about the deficit? That's something that we hear a lot about of what is what's happening with the deficit. How much should we be concerned about it, and impacting the level of growth of the market, but just the thing that doesn't get talked about that's just looming there in the background.
Yeah, it's a very popular topic, Megan, certainly. So I did mention that that's one of the upward pressures on interest rates is the deficit, right? And this is why the tariff revenue is important because without the tariff revenue going to the Treasury, we would have more deficit spending than we had last year, right? I
Okay.
mean, right now I
Yeah.
think the deficit relative to GDP is still under 6%. If you added a couple trillion over 10 years from the stimulus, that's the Congressional Budget Office budget window, uh, you wouldn't be under six anymore, right? You'd probably be north of seven. So that's critical. As long as the tariff revenue comes in, and right now I think the tariff rate is tracking to like 10, 11%. We'll see what the Supreme Court does. They may make it a little bit complicated if they strike down half of those that use the IEEPA as their legal basis. The Trump administration is going to have to scramble and figure out a way to put them back on. They probably already have a plan to do that, but that could cause the tariff rate to dip a little bit and therefore cause less tariff revenue. So I think you're going to see rates bump up a little bit if they do strike those down. But you'll also see companies, if they're going to get a rebate, you might see the market buy some of the stocks that were hit hardest by the tariff rate. So I don't know, there's kind of countervailing forces there. But I think the key number to watch is just deficit to GDP. Keep it in the fives, and that's fine. And then keep the 10-year yield in the fours. I mean, preferably below 4 or 5. But the market has shown that it can handle maybe even a little bit above 4 or 5. Those are really the only two numbers to watch. And it should be a good stock market year if that 10-year yield stays in that range.
Okay. Thank you. And in the meantime, did we have anybody with a question?
Thanks for the heart emoji.
Yeah.
We love the heart emojis.
Better than the thumbs down emojis. So
By the way, this presentation is based on the Outlook report that we put out a month ago. So if you don't have that, just let me know or let Megan know, and we can show you how to find it. Or if
yeah.
you want hard copy, glossy copies, all fancy, let me know that too, and
Okay.
I'm gonna get some
Thank
of those
you.
tomorrow, I've been told.
Thank you. We do, just so you know, for anybody who is on the call, in our monthly newsletter, we always do have a market outlook that's always available, the most recent market outlook for you at any time. And I forgot to mention, I think it was an auto recording, but I forgot to mention that this presentation is also being recorded, and we'll attach that to our newsletter as well. So if you want to hear this again or pass it along to somebody who wasn't able to make the call, you'll be able to do that as well. Um, I'll ask maybe one final time if we have any other brave souls that have a question they're burning to get answered here. Any takers? Okay. I'm guessing Julia or Bryant, you would let me know if you saw anybody. Um, all right. Well, with that, we'll take this opportunity to wrap up for today. And again, Jeff, thank you so much for your time and sharing your expertise with us. And for all of you that are joining us, thank you for your time. And we're always here for you, as you know. We look forward to reviewing your financial plans and your portfolios with you as these months progress and we get into the year here. But we're always here if you need anything. And it wouldn't, I wouldn't be me if I didn't end us with another quote that I found. And I thought this was kind of important when we talk about how we invest and there being a plan, right? We always have your financial plan, just like with you, Jeff. You have an idea of the plan or what, the roadmap that you think the market's going to follow. And things aren't always like we expect. But I found this quote. It says, notice how the GPS never says you made a mistake. It just says recalculating. In 2026, let's embrace the detours, adjust course, and keep moving forward. So we always are here to help you do that. And I always think it's good to just have a little more of a positive outlook. No matter what happens, we'll be in it together and navigate it together, whether it's the curveballs life throws us or the markets or whatever it might be. Teenagers, right, Jeff? We'll manage. So again, thank you everybody for being with us today. Really appreciate everybody's time and attention, and we hope to talk to you soon.
Megan, we actually did get one question, one hand
Oh, we
raised.
did.
Oh,
Okay,
Yes.
great.
perfect. It looks like Barbara. And let's see if are we able to take Barbara off
I
mute?
just requested her to unmute.
Okay, perfect.
I just wanted to know what kind of a dog Bella was.
Great question. Bella is a miniature Labradoodle. She's
Oh
about
my.
22 pounds. So chocolate
Oh,
chocolate covered mini Labradoodle. She's a doll. So
oh, I
I
bet she is.
I should have prepared a slide with her picture on it. So we'll have to do that next time.
Yeah, next time.
Absolutely. Thank you.
All right.
Thanks,
Thank
Barbara.
you for joining us, Babs.
Yeah, right. Always a pleasure.
Yes. All right. Well, that was an easy one, Jeff. You got out pretty easily. So,
Love that
all
one.
right. Again, thank you, everybody. Be well, and we look forward to talking with you soon.